What is good, my bro jaronis? Today's episode is going to be about liquidity, finding liquidity. What is a liquidity sweep and what are SMTs? It's going to be, I don't know how long the episode is going to be, but that doesn't matter. Let's get into it, into the chart as always. So let's get to learning. We got our NQ chart as always. The camera sizes are always going to be different because I never do it the same. Anyways, let's go over what is liquidity. Okay, so liquidity, first off, the concept of liquidity is essentially liquidity is the amount of orders that are placed at a certain price range. That's how much liquidity, and how much liquidity a market has is how many active market buyers and sellers there are. So a very liquid market is very easy to take out money. It's very easy to put in money. A very illiquid market is very difficult to take out money, very difficult to put in money. Okay, so that's like the concept of liquidity itself. Now, liquidity in the charts, which is really important because after this is going to be objectives, which is like the most essential part of my trading strategy, I believe, is that liquidity, it's essentially the beginning of liquidity is areas of where there are a lot of orders. All right, so let's just put an example here. All right, let's say we're in an uptrend. Okay, so we're in an uptrend, we're going up, we're going down, we're going up, we're going down. We're in an uptrend right now, right? So where do we expect a lot of orders to be placed? Well, obviously at the bottom. Why? Because this is the point of where the trend began. Let's say we were in a downtrend first and we turn into an uptrend like this, right? For us to go from a downtrend to an uptrend, we got to see a lot of buying pressure. Therefore, a lot of people are placing their long orders here. What are long orders? They want to buy. They're pushing price up. They're buying, okay? Therefore, once they make all this purchasing, they have to set their stop loss. They're like, okay, I'm going to start buying. I'm going to start buying here. 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 Where do I want price to not go for me to exit my position? At the very bottom, the beginning of the trend. That's what liquidity is. Down here, there's orders and orders and orders and so many orders. If you go to the order book, there's so many orders here, 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 here of people saying, hey, if price comes into here, I'm forced to buy back at that level. So I don't want that. But what that means is that it's a magnet of price because, look, imagine it again. I always give the same example. Imagine the apples and the apples example, right? Imagine the apple market sees that we went from a downtrend to an uptrend. So apples are going up in price now. If we go down into the price of which it bottomed, people don't want it to go lower than that. Therefore, we're going to see a lot of buying. We're going to see a lot of buying out of there. We're going to see so many people. It's like, hey, we bought down here, but prices are up or up here. I want to see price stay up. I don't want it to come down. So down here, there's a shit ton of people that are ready to buy up apples again because they want to drive the price up. So what did the market do? It's smart. The market is intelligent. It thinks, it's like, wait, I want to fill all these orders. I want this to happen. So therefore, all these orders that are going to get filled brings price down as a magnet, causing what is called a liquidity sweep. All right, so we go down, boom. We take out all these orders. We take them all out right here. The orders are being all executed, and usually, but not always, it brings price higher. That's how, and then this is like where you say, oh, now I can start to determine, where the beginning of trends are going to be. Okay, so that's basically like liquidity explained in that sense, where liquidity is like essentially where the orders are being placed. Therefore, we can expect price to bounce off and react of those areas, right? So let's get into the chart for examples, and this is where candlesticks thrive. This is where those magical wicks come into play. Okay. You might ask just like, wait, there's a wick here. There's a wick here. There's wicks everywhere. But there's, the bigger the wick, the stronger the liquidity. That's what it is. And obviously, the higher the time frame, the stronger the liquidity too. If I have the previous day's high up here, and then I have a tiny little 1 minute liquidity, of course, I'm more likely to see this one bring price down than this one, because this is a whole day determining, hey, it's like, hey, we were up here yesterday, we're going to go down. That's kind of how it's determined, okay? So now let's get into the examples, right? How do we find liquidity? Liquidity is everywhere. I mean, I could literally go on forever and ever and ever. There's liquidity. Boom, right here. There's liquidity. Boom, right here at this wick. There's liquidity. Boom, right here. There's liquidity. Boom, right here. There's liquidity. Boom, right here. There's liquidity everywhere. Okay, the stops orders and the limit orders, they're everywhere. They're all everywhere. Okay, this is all like an order book. But we need to recognize what is good and what is bad liquidity. Okay, so good liquidity and reasonable and strong liquidity usually comes from the daily time frame, the 4-hour time frame, or the 1-hour time frame. Less than that is like kind of irrelevant, to be honest. So let's identify here some strong 4-hour liquidity pools. Boom, right here. What do we see? Price came down into here, formed this wick, meaning that this whole area is rejected. We don't want price to continue going down in here. We saw price bounce off of this area. So what do we expect? A lot of orders to go here. A lot of orders to be here. Okay. Another one right here. Boom. This whole area right here. A lot of liquidity here. Why do you think we still haven't tapped it? Because every time we want to go lower, nope, not happening. What else? Right here. Huge liquidity pool right here. Boom. Right there. And then boom, down here too. Look what happens. Sweeper, boom, we go to the other direction because all those orders are being filled, meaning that now, look what happened in the past. Price came down into here, we saw rejection up. Price came down into here, we saw rejection up. Price comes down into here, fills all these orders because price went and targeted them. And these are buy orders because in order to take a long, you need to put a buy stop as your stop loss. And then boom, we go straight up. Okay? That's like essentially how you find liquidity. So now that we have liquidity and we understand it, how can we apply it? How can we apply liquidity to our trading? Well, liquidity sweeps are a pretty essential part of both objective setting and the beginning of our trades. What I like to do is, and this I'm going to explain more again in the next video, which is objectives, which is going to be super important. And what it is basically, I want to see points of interest where I believe price is going to flip out of. So, for example, this whole area right here. We see this whole area right here. Every single time we came up into here, price moved down. Move down, move down, move down, move down. So, I mark the highest point of the area as my liquidity sweep. This is the highest point. Look what happens. This was today. We swept it, and then we just went down. We shut the bed. You know, we saw the reactions to the downside. So that's liquidity sweeps in that sense. Now, again, 4-hour liquidity is stronger than 1-hour liquidity. So if we go to the 1 hour, like this is not a strong draw on liquidity down here. But this right here, it is because this is a 4-hour draw on liquidity. This is not. This is a strong liquidity because it's 4-hour, but these are not. So you need to understand what is good and what is bad. Okay? That's basically it for liquidity. I mean, as you can see, let's go back to the chart, like randomly, any point, boom, right here. Okay, what happens? What do we see? Let's go like right here, whatever, it doesn't matter. What do we see? Price. In this case, and this is where I'm gonna go to a next concept, which is disrespecting liquidity, and I'll explain in a second. Price, okay, we have liquidity down here. Okay, perfect, we have liquidity down here. We have liquidity down here. Then we have liquidity right here. Oh, look what happens. We sweep liquidity, and then we can guess on the lower time frame. If we go all the way back into here, I don't think it's gonna let me. I think it's way too far back. Yeah, okay, we'll just have to stick with the hourly, unfortunately. Well, we came down here, we swept, we saw a rejection, boom, we go to the upside. What do? We take out this liquidity right here. We take out that liquidity, boom, we go to the downside. What happens? We form all of this liquidity over here. What do? We take it, boom, we go to the upside. It's really that simple. Then right here, we form this liquidity. What happens? We take it, boom, we go to the downside. Boom, we take this liquidity down here, boom, we go to the upside. We take this, we go down. We take this, we go up. We take this, we go down. Like it's truly that simple. And these are important because these are going to be the places where you want to put your take profits. This is where you're going to start taking profits. And your take profits are basically points of interest where you don't want price to reverse. Okay, so that's like essentially liquidity and liquidity sweeps. Now I'm going to get into a concept that I personally don't use that much, which is SMTs. And what it is imagine this, right? And I'll put it this way. So like I'll bring us out over here so you guys can see ES, which is, you know, the S&P 500. There was I believe an example today of liquidity or like an SMT. There's one right here. So there's the apples market, and then there's the red apples market and the green apples market. They move essentially the same. Okay, the red apples market comes up into a previous time, like the red apples market comes up and sweeps liquidity. Let's say we swept the liquidity at $5, and we're seeing initial rejection to the downside. But the green apple markets, we didn't even go to the $5. We actually started moving lower before we got to the $5. So there's the SMT. There's like the difference in price where the green apples are telling the red apples that we want to go down. So we want to start selling our red apples up here because they're at a premium. They're a more expensive price, meaning that we can go and get bigger profits in that sense. Or if the red apples are, you know, holding on strong, then we can start selling the green apples because we can expect them to go lower and lower and lower and lower. Okay, and it works both ways, both bullish and bearish. So let's take a look at a couple examples in the chart. Obviously, again, the higher time frame, the better. Here's a great example. What do we see? We see this high from Wednesday, 11th of February 26, get taken out on NQ. We see that we swept it, but on ES, we didn't sweep it. We didn't sweep it. We didn't take it. We didn't get to this area. So what does this tell us? If we're seeing rejections out of here, we didn't take this, and we're seeing sell-offs for no reason whatsoever, because there's no reason for us to be selling off on ES, we can expect NQ to follow, leading us to a better entry. I mean, look, would you rather enter a short all the way up here or all the way here? Just for them both to go, you know, to the same objective. So that's why we capitalize on that. That's basically what SMTs are. Now, are they absolutely essential to trading? Not really. They're very situational, and they're not always going to be, you know, super useful because they can be very misleading. And honestly, I feel like lately it's just not been worth it to mark them out or to, you know, to do anything in that regard. Like it just doesn't seem like it's really worth it because it has to like corroborate with a lot of things. But I thought I'll teach you guys the concept itself because it's really important to understand, you know, whenever it does happen. Okay, so that's basically it. Now, how do we apply it to our strategy? Well, let's go to the lower time frame now. Let's mark out some highs and lows. So let's mark out here some highs and lows. Let's just go back to the replay mode. Let's just go back to like here, bro. For example, let's just go back to like here. Okay. Let's mark out some highs and lows. Let's mark out some highs and lows here. Okay. Well, let's move a little bit more so we're closer to the highs and lows. Okay, here we go. So here's something better. Okay, we have this high right here. And then we have these lows right here. And then we have these highs up here. Perfect. Now we can scroll to the lower time frame. What does this do? So if price has come up into here and changed the direction, we can expect price to come up into here and change the direction, correct? So what do we see? Let's go to the 5-minute here to like play it safe. Price comes up into here, takes out price, and we should expect to see bearish reactions out of it, but we don't. Oh, what? What do we do now? Is this did I lose my trade? No, you didn't have any confluences to take your trade in the first place. What this is what I call a rejected liquidity sweep. And this is a fantastic confluence because what it tells you is, hey, in the past, when we came up into here, price actually went down, but we're not doing that anymore. So what does this tell us? It tells us that people that sold up here are no longer interested in selling up there. They're actually willing to sell way up here and like buy. You know, they're buying up the price. So therefore, what it means is, okay, if we see us trade completely out of here, not see any rejection whatsoever, we can expect price to continue going higher. That's, you know, in this case, that's what it does initially. And once we see a corroboration, so, you know, a continuation of a trend, so a higher high right here. Let's see if we get it. Okay, we get a higher high right there. what do we see? We continue going higher. We're going higher, we're going higher, we're going higher. Okay, so we're moving higher, we're moving higher, moving higher. In this case, we caught some like consolidation, like price, I believe, ends up going down. Like, you know, we're not really going anywhere. But the point is, like, in this case, we would have been able to catch this trade right here. You wouldn't have been able to catch this long right here. We enter here, and we're able to take profit at here for like a 1-to-1, you know, with our stop loss like here. For like a 1 to 1.5, we would have been able to catch that trade because we saw that we weren't reacting off of this area of liquidity. So that's why it's important to understand this. Now we can go to a different example too, where you can see, like, for example, let's see. Where's there a good example of this? Like right here. Here's a fantastic example. Look, we have a very strong set of liquidity right here. What happens in this candle? Let's select this. Let's select the bar before this. Okay, let's go to the 50 minutes so we can kind of skip ahead. Boom, price comes down. Okay, what happens? Is price seeing any retraces whatsoever? Are we wanting to see us, you know, buy back up even though we did already buy back up in here? Absolutely not. So we can expect price to continue lower from here. We don't want to see price go higher. So that's actually what happens. And I actually did take this trade right here. I saw perfect information. I see that we traded out of this liquidity. We retrace into it, and then we continue trading out of it, meaning that I could expect price to go lower. I ended up taking this trade, and this just like continued going lower and lower and lower and lower and lower and lower and lower. Look at this trade. Like we could have got a huge trade. Okay, so that's rejected liquidity, rejected areas of liquidity. That's like the concept itself. Now, yes, is this a lot to digest? Absolutely. However, I'm not explaining it any other way because I don't want to explain it to you like you're a child. You should already know these concepts. You should know what liquidity sweeps are. You should know what, you know, breaks of structure are. You should know all these things. So I'm just trying to teach you, you know, how can you use it to your utmost advantage. All right. So liquidity sweeps, you know, or liquidity areas where price and orders are resting, both above and below. Liquidity sweeps, places where we sweep the area and then see a continuation to the other side, you know, mimicking the pattern. Then you have rejected liquidity sweeps, which are areas where, you know, we sweep liquidity, but we don't see a reaction. We see continuations on the opposite direction, confirming that we're actually going to continue in that direction instead of flip the direction like we have in the past. It's just those three things. It's literally as simple as that. So remember those three concepts. And basically, like, again, this video isn't that important because like it is a pretty big part of the strategy to understand what liquidity is, you know, rejected liquidity and so on and so forth. But it's not the only thing you need to know. Like, you don't get so caught up in the concept themselves. Just understand what it means in the big picture. At the end of the day, what matters is the strategy itself, which is actually going to be, I believe, I mean, I already made like a strategy video, but I want to make a more detailed with a checklist strategy video, which is going to be not the next video, but the video after this. And yeah, the next video is going to be about daily bias and trading with news and setting objectives. So that's really important because it's the last thing I want to cover before we can get into the actual full strategy itself, where you're going to be able to trade with perfection. You're going to be able to trade everything you might want in like any case, like in any scenario, any market, anywhere. Okay, so I'm gonna leave it at this. I know this isn't the greatest video I've ever made, but I feel like you should be able to understand liquidity. Remember, liquidity is where orders are resting, where we want to see price historic. Remember, price is all about history. What did it do in the past? In the past, in this area, we saw reactions up. So when we sweep this area, if we, for example, in the future, sweep this area, so come down here, I would expect price to bounce higher. How high? I have no idea, but to bounce some type of high. And then same thing, if price comes up into here, into this area up here, I would expect it to bounce down. How low? I have no idea, but I would expect it to bounce down. However, if we don't see a bounce down, so we see a move up and then a little bounce and then a continuation up, we can consider that a rejected liquidity sweep, meaning that we can expect price to go even higher, so defy what the past has done. Okay, that's basically it for liquidity and liquidity sweeps and then also SMTs. Again, not a super important concept. If you don't understand it, go look up another video on SMTs because there are better videos out there. However, they're not that essential. Like, it's not gonna make or break your strategy. Sure, it might help sometimes, but it's not gonna make or break your strategy, or at least my strategy. Okay. All right. I'm gonna leave the video at this. I'll catch you guys on tomorrow's video. This will be uploaded on Friday. Next video will be uploaded on Saturday. I'm gonna have to record these because I'm gonna be out of town. But that's all right. So you guys will have videos all throughout the whole weekend. Next video again, daily bias, trading news, and setting objectives. So that's what we'll do for the next video. All right. I'll leave it at that, guys. I hope you were able to understand. If you have any questions, any comments, join Discord, shoot me a DM on Discord. It's all free. You'll see all my thought process and everything. And leave a comment down below. All right. Peace.